So I think when most people think of the Canadian energy industry, the thoughts immediately turn to the oil sands. But it's worth noting that the country is also home to a world-class shale play. It's the Montney shale play. And today on stage with me, I have three executives whose companies are involved in that formation one way or another. To my right here is Craig Nieboer, Chief Financial Officer of Pipestone Energy. Then we have Bernie Lee, who is the CFO of Paramount Resources, and Tony Aulicino, CFO of CES Energy Solutions. So I wanted to start with just have you introduce your company a little bit and what what your development strategy is at the moment. So we'll start with Craig.
Yeah, so Pipestone Energy is a brand new company. We went public in January of this year, so probably none of you have heard of us. Like lots of energy companies, we're bringing on a lot of production, which is great. We're going to be approximately 15,000 BOE here at the end of the year, and about a little over 40% of that will be liquids, which is where all the money is made in the Canadian space today. But kind of more importantly about Pipestone, it's been the advantage of coming late to the party, let's say, as a new company. We've been able to construct the company in the way that it needs to be constructed in today's capital markets. So from an ESG perspective, it's all brand new infrastructure. It's designed to be zero emissions. From a growth perspective, we can grow our company under our own cash flow and steam. And from a balance sheet perspective, we see keeping our debt to EBITDA ratio under 1.5 times. So these are the things that you need to do to be a relevant energy company in today's world in our minds.
Bernie?
Okay, I'm Bernie Lee. I'm the CFO of Paramount Resources. We are almost the opposite of Pipestone. The company went public in 1978. We just had our 40th anniversary. We believe we are the public E&P company that's got the longest history in Toronto Stock Exchange. The company was founded by a gentleman called Clay Riddell. He's a geologist by trade. The company, the way we operate is that we try to use technology like G&G technology and identify a play early. By identifying a play early, we can get in and buy land cheaper and gather all the good land that we believe are good land. And then we go and delineate and develop it. And then as the cash flow come in, the properties become mature. We can either harvest the cash flow or we monetize the asset. Our current focus is on the liquids-rich Montney play. And also we also have the Duvernay in Kaybob as well as in southern Alberta. I think the audience can go to our website and look at the individual properties. As far as the high-yield market is concerned, our first entry to the U.S. high-yield market is in 2003. Since then, we have done different issues in both Canada and the U.S. The last issue that we did in the U.S. was in 2015. We were in the midst of growing and expanding, developing the Musgrove property. Unfortunately, at the end of 2014, commodity price just cratered. So we came down, did the issue, completed the expansion and growth, and then we did something that people did not expect. We sold the property to deleverage the company. Okay. Throughout the history of our high-yield involvement, everybody always gets paid, and that's the important thing. In addition, because of our high ownership, the last thing the shareholders want is to restructure the high yield, right? Because it dilutes our interest. So that's the genesis of the company.
And Tony, your company's a little different too. You should note that you're in services and you're also very heavily focused in the Permian Basin in the U.S. with sort of a foothold in Canada as well. But if you want to expand on that.
So definitely some similarities and lots of differences. So Tony Aulicino, CFO of CES Energy Solutions. We are essentially a manufacturer of consumable chemicals. We buy raw chemical materials, we combine them, we react them, and then we sell them primarily to the energy industry. So in 2018, we had revenue of $1.3 billion Canadian. 70% of our revenue is in the US. The balance is in Canada. Last quarter was actually 76% in the US. About half of that is in the Permian Basin. When we look at our end markets, our two main end markets are production and drilling. We sell production chemicals to help our customers, and our customers are producers, not intermediaries. About half of our revenue gets sold into the production chemical business, which is a nice free cash flow, steady Eddie recurring model, simply because those producers need to continue to generate a return on the capital they've already spent to justify that production expenditure. And the other half is essentially drilling fluids, chemistry, and that's essentially chemicals that get included in drilling fluids to allow those producers to drill very effectively and safely. The other thing that we don't talk about a lot that is actually an area where we have been diversifying is the fact that there's still a small part of our revenue that gets sold into adjacent markets. We sell into the industrial market, currently selling into the paint industry, the water treatment industry, as well as the cosmetics and agriculture end market as well. Again, small parts of our business. The majority is energy. From a capital structure perspective, we have a free cash flow generating business model. It's consumables based, it's CapEx light, it's asset light. As a result, our free cash flow generation is very high. We were nudging on just under 3 times debt to EBITDA at the end of 2018 because of some very well-placed CapEx in the Permian and in Canada over the previous couple of years. Since then, over the last 2 to 3 quarters, we've demonstrated our free cash flow generating capability. We had $160 million drawn on our senior credit facility at the time. It's down to $95 million now. We have $300 million of notes outstanding, maturing in 2024, 6 3/8 coupon yielding just above 7%, and very comfortable with our leverage that has been going down now just around that 2.5 times range. And if you believe research analyst estimates, we'll be generating free cash flow of $70 to $90 million in 2019. And we'll use 80% of that free cash flow to continue to pay down debt and the balance of 20% to buy back shares.
Right. So pipelines are always an issue in Canada. Obviously, the big problems are on the oil side, but there's been a lot of tightness in the natural gas system in Canada as well. It seems sort of some of the same issues. So, Craig, how has that tightness affected your company, and what are you doing to mitigate some of the obstacles that causes?
Yeah, so real high level again, we're making most of our economics, as Bernie is, on the liquids, on sort of the oil that comes out of these wells, but these are gas wells essentially that produce a lot of gas. And AECO, which is the Canadian spot price for gas, has been the weakest sister in the North American gas complex for a long time. And part of that is the infrastructure challenges that exist in Canada from offtake. So you may be familiar that there is an LNG project that's finally been sanctioned for the west coast of Canada. But the NGTL system, which is TC Energy, or it used to be known as TransCanada, is being expanded in a number of places, which is going to help improve offtake for gas out of Western Canada. And then as well, they just implemented an old system. They re-implemented an old system that's allowing non-firm gas transportation to not have to go, that it can go into storage, which is really going to eliminate a lot of the big fluctuations between winter and summer gas in Canada, which had caused a number of negative gas days for pricing in Canada on a spot basis. That, combined with Alberta entering this winter at the lowest storage levels in over a decade, it looks like the dry gas component of our hydrocarbon mix, Bernie's and mine, will attract a little bit more cash value on an AECO basis this winter, and hopefully over the next few years. So we may still be the weakest sister in North America, but not as bad as we've been over the last 5, 6, 7, 8 years.
Bernie?
From our perspective, we will not go into heavy capital development of a project until we know that we have got egress in place, because there's no sense for us to sink in capital and then cannot sell our products. I agree that, in addition to liquids, we also have transportation on TCPL, and the current proposal is good for us because it will relieve some pressure on AECO. And since I think last week, AECO has been having uptake after the announcement.
And Tony?
Yeah, from our perspective, we continue to do best when we serve clients like the two on this panel. So their success motivates our success. The other thing I would mention is this renewed focus or accelerated focus on increasing efficiency for transportation through pipelines actually provides an opportunity for us. We're not a big player, at least not yet, but there are specific chemistries that are being leveraged to increase the laminar flow through those pipelines and through some of that midstream infrastructure. And that's through things like drag reducing agents, which are areas that we have the capability of growing into as well.
Right. And I mean, obviously the other pipeline problem that's happening in Canada right now is with the oil, and I know the oil sands are a big customer of yours. You've sort of started to touch on this, but how is the sort of situation that the oil sands has been in lately? How is that affecting your business?
Yeah, look, when you do your homework and take a look at the oil sands, there are a lot of reasons to really like that business. And just to step back, the major players in the oil sands are some of the best capitalized companies in the energy space in North America. They've taken advantage over the last couple of years of consolidating positions and becoming even more efficient. We like that space because we're a major player in the SAGD drilling space. We like that space because it's got a massive production chemical component. The CAP group 3 years ago estimated that the production chemical spend for oil sands is $800 million. And we're just getting into that market right now. The two leading players are Nalco Champion and Baker, and we're trying to follow them. And the other big thing is the fact that we benefit directly from the oil sands and also indirectly. If you look at the diluent that's used, and these guys have a great position to support that, the condensate that's required to make that diluent run down the pipelines is essentially almost, at least in Canada, significantly taken from the Deep Basin. And that's where a lot of drilling and production happens. And that's where we spent a lot of capital in our Grand Prairie facility to position ourselves to benefit from guys like these that are doing very well to provide that condensate that's used to support the critical transportation requirements of the oil sands. And I would put those decline numbers that the oil sands has next to anybody in North America. It's one of the best.
So given some of these headwinds that the Canadian energy industry is facing, how does that affect how you go about managing your balance sheet and planning your borrowing? I'd start with Bernie on that one.
Okay, for balance sheet perspective, our philosophy is that on average, we would like to have a debt to cash flow ratio of less than 2 times. During growth period, we will exceed that. And as illustrated and demonstrated historically, we always pay down the debt, regardless of how bad it was. And then we grow again because we got prospects and we're happy. For the current situation, I have $1.5 billion of committed bank line till 2022. And on a pro forma basis, after we sold some midstream assets to pre-fund our next year's drilling, is less than $600 million. The street, some high estimate is around 900. So as you can see, I still got $600 million of dry powder and liquidity. So there's no liquidity issue. That gives us a lot of flexibilities to accelerate growth, or if there's something that's reasonable enough from our perspective to buy, we will do acquisitions, but it has to be at the right price, or we start distributing money back to our shareholders. So we want flexibility.
All right. Craig?
Well, I think the industry on both sides of the border has been criticized for not actually returning corporate level returns, and definitely not corporate level returns that meet other industries. So Pipestone, again, I'm repeating myself, has been built to be able to sustain itself on its own cash flow, grow out of its own cash flow, and keep its debt ratio under sort of 1.5 times, and having return on capital employed numbers that are going to be competitive with not just our peers in the oil and gas industry, but your other opportunities to invest in other sectors of the space. And I think that is the key for a junior oil and gas company to be successful in this marketplace.
And Tony?
From our perspective, I already touched on it. We're very comfortable with our capital structure. About half of our revenue, as I mentioned, is from very predictable, stable, recurring cash flow generated from production-related chemical sales. So very comfortable with that. We were skirting around 3 times debt to EBITDA, like I said, at the end of last year. That's because we finished our CapEx program in the Permian and in Canada. And if you look at what we've done with our surplus free cash flow, we'll continue to pay down debt. We were just above 2.5 times at the end of Q2. You can look forward to that multiple going down over the next year, probably skirting through 2 times. If we find an opportunity to pick up a business as a tuck-in or spend capital for accretive returns in an ancillary or adjacent market, we will. Depending on the nature of the recurring cash flows of that business, that'll dictate where we want our leverage to be. But right now we're at 2.5 times, and that continues to go down. And the other thing to mention there is that the majority of that debt is working capital. So if you go back to 2015 and 16, the beauty of our business is that when the market softens or goes down significantly, we harvest that working capital. So from that 2015 to 16 level or time frame, we actually put $75 million of cash back onto the balance sheet.
So ESG is always a big issue for energy companies. Last week we saw Norway's mutual insurance company divest from 4 of the Canadian oil sands companies. Seems like every couple of weeks there's some fund, often European, that is divesting from the oil sands. Obviously, none of the companies here are oil sands, but was curious, being in the Canadian energy space, how often do the ESG issues come up when you talk with your investors? And I guess we'll start with Tony.
Yeah, so it comes up quite a bit, especially for investors or potential investors that don't know us well enough. A lot of investors at first blush don't realize that we are not a producer and we do not extract fossil fuels, which is one of the first things that they focus on. However, a lot of investors forget about the G and the S in ESG. So from a G perspective, governance, we, like our partners in Canada and the US, spend a lot of time and effort making sure that governance is world class. So you look at our board structure. The other thing that we did over the last year was we significantly changed the executive compensation structure to align itself with stakeholder interests by introducing things like EBITDAC margin, CapEx, balance sheet management, relative TSR, relative ROCE, to align those interests with stakeholders. So that's the G part that we're very comfortable with. When you look at the social part of ESG, I, like many of our public peers in Canada and the US, have world-class reputations in terms of how we operate under social license. In my opinion, much superior to a lot of our global competitors in the fossil fuel industry. And on the last one, on the E, the environmental, we can't change things that are not in our control, but what we do is we help our customers solve the problems at the well site. We provide chemicals that treat the waste and pollution that otherwise would have to be sent somewhere else or treated somewhere else. So number one, we help to reduce the production of those nasty pollutants and waste. Number two, which we're realizing even more so, is we actually help our customers reduce their carbon footprints by reducing the amount of trucking and transportation that they otherwise would require to transport those wastes to disposal sites and to other areas for treatment. There are some novel technologies that we're looking into, probably not ready to be talked about in a significant way yet. But again, we're using our chemistry, our scientists and engineers to develop ways of helping us make money. And the corollary is helping some of our customers with their carbon footprint as well.
Bernie?
From ESG perspective, start with the E. I don't know whether the audience is aware that Canada has got the most stringent environmental regulations. Okay, so to say that the oil and gas is a polluter, I don't think it's fair. From individual companies' perspective, we have been continuing upgrading our equipment. For example, we changed a bunch of controllers at the wellhead. It reduces our operating costs. In addition, we reduced the greenhouse gas emission, and actually I'm banking greenhouse gas credit. So if somebody wants to pay the right price, I'll sell it to you. Okay. From the S perspective, we explore in Western Canada, and we work with the natives from time to time. And there were times that we found joint venture with the natives, or we hire them to help us to do the work. From a G perspective, corporate governance is important, especially when we have a majority insider ownership. And the one thing that guarantees is that because of the majority insider ownership, management and the shareholders, the objectives are aligned.
Just in interest of time, I'm going to focus on the one that I think actually is driving investors, which is the E. I think as a public company, people expect the S and G to be there, and it is. So again, for us as a new company, Greenfield, we are coming at E with all the modern technology, latest infrastructure, zero emissions facilities. So we think we check the box on E as best as anyone in the oil and gas business in the entire world could possibly do it. I think the other thing that should be important to know is that natural gas is probably the most efficient bridge fuel that this world can ever rely on to get to a panaceic world of zero emissions that we ever think to get to. And the United States' biggest drop in its emissions over the last 5 years has been a direct result of the adoption of natural gas to produce electricity away from coal. And we in Canada are very focused on that, both in Alberta with more natural gas electricity generation going on, but also exporting LNG to Asia. And at the end of the day, the biggest thing we can do as an industry, and quite frankly as a community of countries, is get China off coal and onto natural gas on its electricity generation.
Right. And so obviously the election has been a big topic of discussion today. I know it's usually a big topic of discussion around Calgary. So I guess I'll start with Craig. What's at stake for the energy industry in this election? What would you like to see the next government do to support the industry?
Well, I think what's probably not understood outside of Canada is this election in a lot of ways is a referendum on the future of energy in Canada. 3 of the national parties have lined up with strong platforms against carbon with a direct bullseye on the oil and sands business in Alberta, which actually pays a lot of the bills for the country. And I think that as this election goes, depending on the outcome, it will have serious ramifications to the future of energy in Canada and potentially the future of what Confederation in Canada will look like. Again, back to my industry partners here, we have survived through all scenarios. We will continue to survive through all scenarios. And we have businesses today that make money despite the discounts we take for our products and the challenge we face with offtake. And I'm very confident that we will continue to thrive and survive. Obviously, a more right-wing leaning government might be more helpful to us in that endeavor, but without a doubt, the Canadian industry will succeed no matter who is in power in Ottawa.
All right, Bernie?
I would echo what Craig had just said. Like right now, assuming that there's no more new oil sand projects, there is still a shortage of condensate. So it's good for both companies because we focus on condensate production and gas production. But having said that, it's still tough for Alberta and for Calgary, especially some of our competitors who have less condensate and dry gas producers. And we have been in recession. Alberta has been in recession for a number of years. And let's see how the government's going to help us or whether they're going to help us at all.
All right, Tony?
Look, I don't have a lot to add. I'd like to see the new government in power take a pragmatic approach that takes a look at the facts and the relative record and the people and the work that peers like this have been doing and all Albertans have been doing. And Albertans are survivors. They've proven that through other downturns, and I full well believe that we are going to continue to do that. But it would be great to have that new political ruling power step back and take a look at the big picture and how important this industry is to Canada.
Right. And Bernie started to jump in on my last question. I've got to get everyone on the record on this. Craig, what do you think are the odds of a recession in the next 12 months?
Well, I think it's interesting. Bernie said it. Alberta's been in recession for the last few years, so we've been in recession in our region in the country. I will agree with other panelists I heard earlier, though. I think for a Canadian recession in general, it's probably not a made-in-Canada situation. It's probably external factors, and particularly our good friends here south of the border where your economy goes.
Bernie?
Yeah, I've been waiting for recession in Canada and North America for a few years. We have gone through the longest expansion, and sometime, the downturn has to come.
All right, Tony.
Yeah, look, we're going to follow what you guys know better than us. You're our biggest trading partners, and we're going to follow what's happening here south of the border.
All right, that's all we have time for. Thank you very much.
Thank you.
Thank you, Kevin, to our panelists for a great discussion, really a thoughtful discussion about the challenges facing the sector in the sort of the age of new assessments of oil and gas as it relates to ESG. Interesting comment from Craig about this election being sort of a referendum on the oil and gas industry. And I'd point you to the Bloomberg Today, where Kevin and our colleague Natalie Obiko-Pearson just did a piece very much looking at that, sort of the great debate in Canada about the development of our oil and gas industry. So, so I just want to give you another quick news update, if I will. On the political side, looks like Barack Obama has just come out and endorsed Justin Trudeau for the election. He said the world needs more progressive leaders. So that's that. We're going to switch from oil and gas to gold. Gold's having a bit of a moment right now, as you may know, trading around $1,500 an ounce, much higher than what it was last year this time, at about $1,200. So we're going to hear from one of the big players in the gold sector in Canada. And to lead this discussion, I'd like to invite our our mines and metals, rather, team leader, Lucian Javier.
We're fortunate to have with us the CFO of one of the largest gold mining companies and listed in Toronto, IAM Gold. Welcome, Carol. Carol Banducci, please.
Thank you, Luci.
Yeah. It's been these are interesting times for gold when you have like gold hovering near a 6-year high. How has it been like? Do you see our gold mining equities looking more appetizing for investors?
Well, I mean, we've had a tough time since 2014 when we saw gold down at just below 1050. And it's certainly, and I was here a year ago, and as you heard earlier on, gold was around 1,200, and it was only a few months ago it was at 1,300. So it's great to be here and to talk to you when we see gold prices at 1,500 with quite a bit of support at these levels, and perhaps we can see it go higher. But back to the equities. I think the equities are still, I think there's still a lot of cautiousness around gold equities. We certainly are seeing a lot more interest given the increase in the gold price. But like I said, there's still a lot of cautiousness, and I think we would like to see gold, sitting at these levels for a longer period of time. And definitely, I was here yesterday and we met with equity investors, and a lot of interest, both from the specialists as well as the generalists. So we are seeing greater activity.
Right. But whenever everybody knows that whenever there's so much hype around gold, people talk about the supply. What is supply going to look like somewhere years along the line? And the biggest producers are already, like, if you look at the gold reserves that they could tap into, they're about more than half of what they were in 2011. And people are now talking about, is it the right time for M&As? And we've seen some mega mergers like over in the past year with Barrick buying Randgold and then Newmont buying Goldcorp. What do you think? Is there another wave coming after that?
In terms of consolidation?
Yeah, consolidation.
Well, I guess there's two parts to the question you asked. One is around supply and demand. And let me tell you, it takes 10 years to take something in terms of a greenfield project, drill it out, get it permitted, get all the regulators on side, and then build it and operate it. So, we've seen over the last 6 to 8 years, there hasn't been a lot of new projects coming into production. It's becoming more and more challenging to get new projects up and running. So you're definitely going to see a real tightness around supply coming into the marketplace. You're finding that companies have to go to more exotic jurisdictions, and just the regulation is extremely strict in terms of being able to operate a gold mine. So you're certainly going to see those challenges in terms of additional supply. And if you look at some of the majors that you mentioned, Barrick and Newmont's another significant player. If you look at their gold reserves, I mean, they're mining lower grade. It's hard to find high grade deposits. And to your consolidation question, you did see it with the majors, and there's just the industry is very fragmented, and it's tougher. It's just so many companies chasing so few deposits. So there's certainly an opportunity for there to be further consolidation in this industry. And I think it's tough for, I mean, we've got multiple mines, but it's really tough for those single asset companies out there, just because of, you need scale and you need diversification, both geopolitically as well as on the asset side.
Mm. China's the world's largest buyer of gold, and a lot of these Chinese companies have been circling around looking for assets to buy. And among the companies that looks interesting that's been reported is IM Gold. Could IM Gold be in the market?
Well, we've heard those rumors too. I will say, I mean, first of all, we are seeing a lot of Chinese investment in the gold space. If you take a look at, they are buyers of gold. They believe in gold, and we've seen an increase in our shareholder base just generally because there's just a lot of interest in the gold space. And you know, in terms of the rumors, I mean, we talked about the consolidation. From an IM Gold perspective, look at our job is to maximize shareholder value and stakeholder value. And whether we're looking at assets or people are exploring sort of opportunities with us, for us it's all about maximizing shareholder value and not just putting companies together or doing things that don't create value over the long term. And that's what our focus is.
So if an offer comes along at the right price, that's something that...
I always say, I mean, look, I'm the CFO of the company. I think everything's for sale at the right price at the end of the day, but that's not where our focus is. Our focus is really driving our business strategy, leveraging the asset base that we have. We've got second to none pipeline out there. I mean, we've got just a wonderful project that we're looking to get permitted in Senegal, in West Africa, called Bodo, and it's got an over 20% return, all-in sustaining costs around $750. We have a deposit in Ontario. It's over 11 million ounces across all categories of resources. It's a 15% return at $1,275, and it's a tier 1 asset. We've got a joint venture with Sumitomo, so that you'll see more of that type of activity, I think, going on with mining companies, is looking for opportunities to share risks. And this is a $1.2 billion project. We brought in a partner, and we're in the process of de-risking it. But it's a transformational asset, and try to find 11 million